Hey guys, today I'm going over a little stock analysis of how I'm picking stocks for a new portfolio of mine. Yes, another portfolio. I know, I've got too many of them and I'm probably going to make more. Anyways, this one is for the no debt allowed portfolio. Alright guys, I know this is a long video. I'm hoping that this gives you an idea of how I evaluate stocks, looking at balance sheets, income statements, dividend history, price history, and the actual type of the company and whether I think that can hold up through a future recession. I know I edited and jumped around a lot throughout this, trying to keep the hours of video I had to a reasonable length. As you'll see in here, each step allowed me to weed out stocks that otherwise I might have left in had I not looked at that extra data. Getting rid of Thor at the end of my analysis is the perfect example of that. It's important to look at as much information as you can when analyzing stocks before investing in them. And I'm hoping that this video helps show you how I do it and maybe gives you some ideas of how to do it yourself. So forgive the editing and a little bit of jumping around and it being such a long video. Hey guys, so watching the stock market today got me all excited. It was crashing again and I was like, yes, another red day. Prices are going lower. I'm gonna have more stocks on sale. And then in the afternoon, at the end of the day, it rallied and of course we ended up in the green. So I'm a little depressed about that, but that's okay. I did start a new account on M1 Finance, and I originally opened this fourth account. I was basically going to do a value type portfolio where it's just there for me to invest in stocks that I see are on sale. So I'm sitting here screening stocks and whatnot, and I figured I would record some of this so we can make a little video on how I screen these and whatnot. So I came into FinViz here and I put in, I'm looking for stocks that give at least a 3% dividend yield. The price is over $5 because we don't want it to be a penny stock. Debt equity is low, as in under 10% basically. 52 week, I want it to be kind of on sale. It doesn't have to be completely on sale, like, you know, at the bottom of the 52 weeks, because those are very limited. But I want it to be in the bottom 10% of the 52-week highs, you know, within 10% above the low. And I definitely want a volume, so it's trading on a regular basis, so over 200K, and only United States companies. So anyway, I did that, and I'm looking at these companies, and then I'm going into their actual financials and looking a little more macro at the finances, at the balance sheet specifically. So with that, I checked MC. It looked great at first, but then I realized that it wasn't quite as good, and I'll show you why real fast. MC, don't get me wrong, I'm not saying it's a bad company. I'm just saying, you know, they have zero debt, all right, zero short or long-term debt. But what I'm really looking for is one that's 100% financially secure. Basically, I'm looking for one where the current assets, as in what they could get if they sold the company tomorrow. So their current assets, not their overall assets, because that includes a bunch of other stuff in there that they basically wouldn't necessarily get if they sold the company tomorrow. So I'm looking at their current asset value, and I want their current asset value to be higher than all of their liabilities, not just their short-term liabilities, but all of their liabilities completely together. So this tells me that that company is worth more than their debt at all times. And I want a history of that for at least the past 4 quarters, 4 years, that type of stuff. So looking at this one, their current assets are 183.7 million, which is well above their current liabilities, and they have no debt. So it's all great stuff. But their current assets are 183.7 million. Their overall liabilities are 496 million. Not so good. Whereas if we go back to something like Thor Industries, 1.3 billion in current assets over a total liability of 872 million. And it's maintained that level where their current assets are much higher than their total liabilities at all times. They've done that quarterly, and they've done that yearly. Ooh, 1016858. 101. Ooh, they barely were below it on that in 2016. But all these other years, 775, 438, they've been well above the liabilities. So this looks like they have some very solid money management skills. So I really like Thor. Another good one was WDR. If we look at theirs, 1.1 billion basically. Their total liabilities has always been below that. And quarterly for this year, there we go. Total liabilities, current assets, way above it. So these two are definitely meeting my requirements at this point. We're going to continue. After Thor, we have Ben. All right, let's see here. Current assets, 9.7. Total, very low compared to that. Quarterly. Yep, this is another good one. That's limited partnership. We don't do limited partnerships because they give you K1s, and that's a pain in the ass on finances at the end of the year. PACW. Most of these are financial. I mean, I guess that makes sense. The finance industry is there to make money and not be in debt. So, on the quarterlies, okay, 80, total liabilities. Whoa! Yeah, no. There's no way they can meet their liabilities at all. So that one is out. We're looking for very stable financials with a company. We want companies that hate debt, basically. They use it, but they hate. They can use it and they can have some debt, but they hate it. Another thing about like THO, they had zero debt. So let's go back and look at them real fast. So while they had liabilities, because every company has liabilities, they have zero debt, right? Which is awesome. WDR had a little bit of debt. Ben has debt, but it's very well managed. So anyways, back to this. We got PacWest, HWC. Current 698. No way. RES. 640. Hey, now we're getting somewhere. They've maintained it all along. They actually have zero debt. Their liabilities are under their current assets at all times. How are they doing this year? Very well. I like it. We're gonna add them to our little list here of potentials. NYCB 1745. Hell no. Look at the liabilities. T-Row. T-Row is a solid company. T-Row has zero debt, by the way, guys, if you didn't know that. No short term, no long term. They are debt free. Let's see, 2673. Good. They've maintained over 2 all the time, down all the time. That's quarterly. Let's look at annuals. Yep. Oh, that's current, sorry. This is total liability. Oh yeah, they're well over the current liability. T-Row is definitely on the list. Figured it would be. That's why I own them in my Roth. Pets. Pet Med Express. Current assets, 105. Entire low liabilities. Nice. This is a smaller cap company, obviously. But they are handling their finances very well. Let's look at this year. Oh yeah. 105 to 19, 105 to 25. They're handling it very well. So they're going on the list. What's their market cap? 490 million. Yeah, definitely small cap. Great yield though. And these are strict requirements. I mean, let's just look for an example at some known good, what we consider good companies, right? So let's look at Amazon. Now, of course, Amazon doesn't pay a dividend, but we're going to take a look at their financials just the same. It should be good. 59,885. Nope. See, even Amazon uses more debt to do it. Google, 129,702. Okay, they're good. Look at AT&T, which we know has a ton of debt. 349,899. 53. Yeah, their debt's a problem. Let's look at Comcast. Out of curiosity. 23,206. Yep, nope, tons of debt. J&J. 47,194. I mean, none of these known companies that are great long-term history companies have this debt ratio I'm looking for. That's just an absolute amazing debt ratio where they just do not use debt like that. Now, mind you, these companies are great companies. They're using and managing that debt properly to make more profits in the long run. But I'm looking for the companies who are basically afraid of debt. To my point here, I'm looking for very strict and rigid guidelines on the financials that most companies do not meet. What other great companies are out there that you guys can think of? Hell, let's just go in here. Let's go into my Roth because it's full of great companies. Apple. Let's take a look at Apple. I mean, they're known to have a crap ton of cash on hand, right? Let's look at their balance sheet. 131 billion. Nope, they got more debt, more liabilities than they do current assets. Walgreens is a great company. Let's look at theirs. 20 billion. 43. You can tell just by looking at these great companies and their liability to current asset ratio that these guidelines I'm putting for this portfolio are very, very strict. And I want these financials to be, very solid. So let's add all these tickers in here that I just came up with. And we'll take this, copy it. There. There we go. Get rid of the original. And that way we can sort this by yield. Highest to lowest. That cannot be right. Ethan Allen's yield cannot be right. Yeah, no, it's 4.2%. It's 76 cents. But this is saying it's 26 and 4.76. Let's go to NASDAQ and take a look, shall we? They must have a special dividend going because it says it's $1.19 instead of 19. So in January, with an ex-div of January 9th, there's a $1.19 one. Let's come in here, go ETH. This says it's $1. That says $1.19. Which is it, guys? Come on now. Either way, it is. It's a special dividend coming up. That's what's screwing up that calculation. So anyway, it's 4.2. So we're just going to manually put 4.2 in here. Just so it's correct. And then we'll sort. So out of all these that meet all my requirements, looks like RES has the best dividend yield. Of course, you know what? I'm thinking about just adding all of them in here. They all have great financials, great debt ratios. All right, so now that we've found the companies that we're looking at based on the balance sheet and the amount of debt they have, we want all of them to basically have no debt because the ones that do have debt are able to actually pay off that debt in cash. Now that we've found those companies, we want to look at their income statement and make sure these are profitable companies. All right, sorry about that. Somebody came to my door. No idea who it was. Don't really care at this point. All right, back to this. We're looking at Thor. Thor. It's all profit, and this year, all profit. T-Row. T-Row's all profit this year, annual, all profit. And AVX is our last one. All profit, mind you, very low compared to what previous years. Quarterly. Nope. It was negative the last quarter. And why was that? Revenue was decent. I see numbers sticking out to me there. Right here. Income tax. Taxes. Taxes. And revenue. I really do like their yield though. I do like their yield, but with revenue, that's kind of a big negative. Yeah, they had a couple years due to down revenue. I just can't do it. I can't do it, guys. I like you. I want you because of that because they yield, but can't do it. I'm looking for those exceptional stocks, not the mediocres. And you know what? We'll even take these out because, again, I'm looking for exceptional, very exceptional in financial management. So looks like I've got 1, 2, 3, 4, 5, 6. I got 7 stocks here. Those are good stocks with decent yields, actually. So those are going into my portfolio, I think. Right now it's Chevron CAX because they're dividend aristocrats and they're on sale. So anyways, we're going to add our stocks from this index. So WDR, Pets, WSO, Ethan Allen, PayX, THO, and T-Row. 1, 2, 3, 4, 5, 6, 7, which is how many we came up with. All right, and they all meet the requirements. And yeah, I think those are some exceptional companies. Let's take these 2 out. Actually, we're going to sort these by percentage-wise. So let's sum up our entire percentage, and then we're going to sum up those. Fine. So we're going to sum up all of our yields, and then we're going to find out what percentage yield each one of these gives us, and we'll invest the most into that. Let's make this equal to that divided by that. So those are going to be our weightings. That way we put the most money in the highest yielding stocks. And we're going to call this, what are we going to call this portfolio? Extreme Debt Management. Should we look at their price history? WDR. See how they've done this year. Woo. Of course, no company's really done good this year. 5 years, down, max. Yeah, stable. They had a lot of fluctuations up and down. They never really dropped too much from what they are now. I mean, their low was 1344, which is a decent drop, but still. Overall, they're pretty flat line. And considering I'm looking for dividends, that's not a bad thing. Pets, let's look at them. Pets has grown. 5 years, grown. All right. Ethan Allen. Down for the 5 years. Max. 1997 prices. 2010. All right. So they're kind of flat. WSO. Whoa, there's some growth for you. Wow. They're down this year, of course, but they are growing good. PayX. Great growth, great growth. And not down that far this year, really. They might be better than expected. T-Row, down this year, up over 5 years, and great growth overall. And THO. Ooh, they spiked big time, and they dropped big time. Wow. Now, the problem with, oh, this is Thor, actually. I was thinking T-Row. Yeah. They spiked a huge 150, and they're $100 down from that. Holy shit. Just from 1 year ago, December of 2017. Wow, they dropped big time. not much news for them. They make RVs. Ah, it's revenue dropped. People aren't buying RVs? Well, Thor might be a little more risky. What was their dividend? 3.09? It's on the low end. I mean, it's RVs. I'm not confident people are going to continue buying RVs for a long term. I mean, I don't know, man. What's the RV market really like? Especially if there's a downturn or something. T-Row has its own problems, but it's overcoming them pretty good. I mean, its problems are like fund managers and stuff like that. Like people are getting out of mutual funds and going to ETFs. That's payroll. It's going to be around forever. Wks. What did they do again? Air conditioning, heating, refrigeration equipment. Yeah, that's a long-term prospect. Ethan Allen Interiors. Ethan Allen's been around for a long time. PetMed's been around for a while. I think that they're going to be around for a while more. And financial company, of course, will be around forever. RVs. July of last year, it was on fire. And yes, it was. It was really on fire. What the hell? Why were people buying so many RVs last year? Interesting. August of 2018. I like comparing, so when I look at news for a particular company, I like comparing what the price is and trend was at that time. So yeah, our price and trend is down big time on RVs right now. And they're saying, is it slowing? Yeah. RVs, man, they blew the hell up, didn't they? Jumped to $150. Thor jumped to 150 bucks and is now back down to 50. I mean, 150 to 50. Holy crap. That's a 300% difference, right? Well, I mean, 150% difference. Wow. That was, something happened right there, whether it was their marketing or something. Something really happened to spark people to buy so many RVs around this time last year. I don't understand why people would buy that many RVs compared to a normal, which is around the 50 mark anyway. So, I mean, this is about as normal price range as 50-ish. Didn't really kick in to not being a penny stock until at least 2001. 87 and 97. So it took them 10 years to go from being a penny stock to not being a penny stock. And it took them another, I'm going to say 6 years until they became a more solid company. Yeah, I don't know about that, man. As a long-term investment, I'm not so sure about RVs. I think Thor's gone, guys. We're not going to be investing in Thor. So if we take Thor out here, all my percentages should change. So 22, 18, 17, 17. Did we look at the dividend histories on all these? No, we just looked at the one, didn't we? We should look at the dividend histories on these. So WDR. So they're not growing their dividend. Their payout ratio is only 45%, which is awesome. You want it right around 50-ish. Look at their history. They've been paying a dividend for quite a while. 1998. Yeah, it's gone up and down. They dropped it last year. Almost in half. Wow. I don't like that drop last year in dividend, but that's probably what's given us a good price on it. They're consistent though, and they've been doing this for, through the recession, they still paid a dividend. So that's good. Pets, good payout ratio. They've grown it for 6 years. Ooh, let's see here. They've only been paying a dividend since 2009. So 11 years, somewhere in there. But, I mean, that's not bad. It's not bad. 11 years. ETH, they've been growing for 70 years. Payout ratio of 50. It's 2002. And they dropped it in 2009. But continued to pay. They just dropped it dramatically. It'll be nice getting on this special dividend. They've grown for 4 years, have a 87% payout ratio, a little higher than I'd like overall. They've been paying since 2003, so 15-ish years. They dropped it. It's all right. It's all right. I mean, they just reduced the price. They didn't drop the dividend. PayX. 78% is okay. Been growing for 7. Paying dividends since 1996. Wow, they're a better company than I expected. And T. Rowe's obviously been paying for a long time. I've already looked at them in the past, so I think they're Aristocrat. Yeah, 31. So, all right, guys. So, hope that you watching me do a little bit of this stock analysis will help give you an idea of how to do it yourself and what to look for. This is an extreme case. Not all companies that have debt are bad. Not all companies that use debt to make more money are bad. The majority of companies do it. As you know, there's a lot of solid companies in my Roth, like J&J, Apple, Amazon, etc., and they all do not meet these requirements I just put on these stocks for this portfolio. But I wanted companies without debt. So looking at these 6 companies that I found with my screener and investigated further, looking at financials, we can see T. Rowe. We're going to look at their debt, actual debt, not just liabilities. T. Rowe has 0 debt altogether. No debt. Paychex, look at their debt. 0 debt. Wks, their debt. So short term, they have $244,000 that needs to be paid this year. Long-term debt, they have $22 million. And as we know, their overall liabilities is for $22 million. I mean, their cash on hand is $80 million. They could pay off all their debt instantly right now. So they're essentially debt-free. Ethan Allen, short-term debt, none. Long-term debt, none. They're debt-free. Pet Meds, no debt, no debt. Waddell, no debt. Long-term debt, they have a little bit, $94.7 million, which they can easily pay off with cash and be debt-free. So essentially, these are completely debt-free companies. So yeah, since these are debt-free companies, I really should change the name of this to not Extreme Debt Management, but... All right, guys, there's one more company that didn't make the list but should have. I'm not sure why the Finviz stock screamer didn't find it, or maybe it's just not at close to low, and that's why it didn't show up in my list. I don't know why it's not showing up. It meets all of these requirements. The dividend yield's over 3. It's over $5. It has no debt, and the volume's over 200,000, and it's in USA. Pretty sure the volume's over 200,000. I could be wrong. See if that's what it is. This is Garmin, by the way, I'm talking about. Oh yeah, volume's way over. Financials, there's our current assets compared to overall liabilities. It's met it entire time. It has 0 debt. So yeah, this one definitely should have met my requirements on everything. And then income statement, net income, it's profitable, annual, profitable. So I don't understand why this didn't meet. This should have met every one of my requirements. Yeah, if you don't know what Garmin is, they do GPS stuff. They have a lot of devices out there for GPS devices for everything from automotive to aviation to bicycles to everything. So yeah, guess what? We're adding Garmin to our portfolio. It should have been there in the first place. I don't know why it did not show up, but Garmin definitely should be added to this portfolio. It meets all of the requirements. There we go. Now we got Garmin in there. I don't know why they weren't in there. It doesn't make any sense to me. You know another good one that is completely debt-free? Wks Skyworks Solutions. They make microprocessors, semiconductors. The problem is that like 43% of their business relies on Apple. So if Apple decides to not use them, they're going to lose like 43% of their revenue. And that is why I'm not investing in them. That and their dividend yield is less than 3, 7. Now we have 7 debt-free stocks. So there we have it. The no debt allowed portfolio has been created. I have set up funding on this already, and I have deposited $100 already. The balance is $100 that will be invested tomorrow. And I've set up a automatic deposit for this portfolio of $25 a week. So I'll do that for a while, and we'll see how much we get in here. I'd like to get at least $1,000 in there in total, but I am going to dollar cost average into this one over time at $25 a week. So yeah, I'm a little addicted to investing, a little addicted to making these portfolios. M1 makes it nice to have multiple accounts. This is my 4th one, and I'm setting up a 5th one. 1, 2, 3, 4, and I'm working on a 5th at the moment. I'm a little addicted to portfolios and testing and experimenting and seeing how different things and different investing styles perform. Hopefully that's entertaining for you guys, and hopefully you'll be able to see what to do and what not to do. Anyways, that's all I got. I set up the new portfolio, and I got a lot of videos to make every Friday and update. We may have to move some of those updates to, say, Sunday. My work schedule is changing, and Sunday I should have off in most cases, unless I can get that OT in. Once my schedule changes, then I might have to move my portfolio updates to Sunday. I will still try to get the Roth and aggressive dividend one out on Friday, but we will see how that goes. For now, nothing's changed. Videos are every Friday. Portfolio updates are every Friday, and I'll let you know when that changes. All right, guys, have a good one. All right, guys, thanks for watching. I appreciate it. Be sure to hit that subscribe button down below, and if you liked the video, hit that like button for me. If you want to hear any specific type of information, anything that you're interested in, you have any questions, just drop me a comment down below. Let me know what you think. Let me know your opinions on this video or any other video I've made. And if you know anyone else that might be interested in this video, please be sure to share it on your social media and share the knowledge. Thanks, guys.